Good afternoon. Asian markets lost momentum as major indexes across the region erased earlier gains, but oil prices trended higher. Chinese mainland shares also advanced and Hong Kong's Hang Seng Index lost 0.4%. The session followed a quiet day on Wall Street, where the US markets were closed for a public holiday. In Japan, the Nikkei fell 0.25%. Japan's central bank left its short-term interest rate target unchanged, in line with market expectations. The Bank of Japan also raised its near-term inflation expectations. Looking at what's happening in the European markets, European stocks were lower as global investors remain attuned to the policy direction of the US Fed and the start of corporate earnings season. The shortened trading week will feature quarterly reports from 35 companies in the S&P 500, including Bank of America and Netflix. Goldman Sachs is also set to post its most recent quarterly figures today. To talk to us about the latest market developments, we are joined by Martin Smith, who is from Anchor Capital. Martin, thank you so much for your time. I mean, given the fact that we've been talking about the theme of Fed tightening as well as corporate earnings, and we also had US markets closed yesterday, how has our JSE reacted to all of that this morning?
Yeah, so I think there's a couple of themes at play. Like you mentioned, you have in the US and globally this theme of inflation and interest rates, and when interest rates are going to be hiked and by how much and how quickly. I think that's the big theme globally. But in South Africa, you've got kind of the effect of China, because while the US is turning the taps off, China's going to start turning the taps on. You're going to see stimulus come through there. And obviously, that's hugely beneficial for the South African market, specifically our resource counters, which have been on a massive tear the last couple of weeks, as well as obviously the kind of tech space insofar as Tencent and the effect that has on Prosus and Naspers, where you see maybe us being at the kind of end of the regulatory kind of unwind we've seen in China over the last few months. So our market's reacting a little differently to what we've seen kind of globally in the US, where there's a little bit more uncertainty. Things are looking a little more positive on the kind of local market.
How are you interpreting what we're seeing when it comes to the US bonds, especially when you look at the 2-year and the 10-year, and then bring in the fact that oil prices are rising?
Yeah, so I mean, it's obviously largely a factor of what people think interest rates are going to be doing over the coming year. So I mean, we've seen interest rates kind of consensus in the States being 2 hikes this year of 25 basis points each. So 0.5%, to now the consensus being 4 interest rate hikes. So I mean, it's gone up quite a lot in the last few months. I've seen this as high as 8 in some instances with some research. So I think that's obviously very much a function of what interest rates are going to be doing and what people are expecting. So the big kind of caveat to that, and you mentioned it there, is oil and what happens there, because obviously if oil continues to go the way it's going, and you've obviously seen some geopolitical tensions kind of come to the fore in the last couple of days, that could obviously have a further impact on inflation, which obviously then kind of forces the Fed's hand so far as having to push interest rates higher a lot quicker and a lot more.
What's your general view on risk assets at this point?
So I think we need to kind of look at it globally and locally. Globally, I think risk assets seem to be the only game in town. You've heard the expression, Tina, there is no alternative, and that's largely a function of there being a negative real interest rate in the States. So bonds aren't looking attractive. Property also has issues. So equity is still pretty much the only place to be in America at the moment, or in kind of the developed markets. But if you look in South Africa, we are pretty much one of only 2 emerging market countries in the world that has a real rate that's positive. So bonds in South Africa are looking very, very attractive, as well as, like I mentioned, our equity market also looking still quite attractive. So I think it just depends where in the world you're looking to invest, but equities predominantly are pretty much the only game in town.
All right, let's stay with equities. I mean, we've got U.S. corporate season sort of kicking off. We started on Friday. Yesterday, markets were closed, but it continues today. What will you be looking out for, especially when you focus in on some of the companies that you like?
Yeah, so you're right that we started last week with the financials. I mean, we've had 10 companies report so far, another 40 this week, and then just over 100 next week. So it really kicks off next week. And I think we're looking for largely positive kind of earnings growth. I think consensus is around 17% growth on aggregate across kind of all reported earnings this reporting season. But I think the big play is, and like I mentioned at the beginning of the show, everyone is looking for what is inflation, how is that looking in people's kind of reported numbers, and also what is the ability for the company to kind of pass on to the consumer. So I think everything that is important for me in this kind of in these set of numbers is around inflation.
All right, thank you so much for your time. That is Martin Smith, who's from Anchor Capital, giving us his perspective of what's happening in terms of market developments and also what he's keeping an eye on.